Welcome to Bullion Signal, the channel where we look past the daily noise to understand the powerful macro trends shaping our financial world, especially when it comes to gold and silver. Today, we're diving deep into silver, but we're not just talking about the price you see flashing on your screen. We're talking about something far more fundamental: the growing disconnect between the promise of silver and the actual physical metal sitting in vaults. There is a quiet crisis unfolding, a story of emptying warehouses and broken promises that could change everything you think you know about silver's true value. If you want to understand these critical shifts to protect your wealth, make sure you subscribe to Bullion Signal for our latest analysis.
So let's start with a really important question. What if that daily price ticker, the one that goes up and down, is becoming, well, an illusion? What if the real story, the one with massive implications, is happening behind the scenes as physical silver is being drained from the very system that's supposed to back its price?
You see, to really grasp what's going on, you have to understand that there are really two different worlds for silver. They operate side by side, but right now, they're on a collision course.
On one side, you have the paper market. This is the world of financial contracts, futures, and high-frequency trading. It's fast, it's digital, and it's where the price you see on TV is born. But these are essentially promises of silver. Then you have the physical market. This is the real deal. We're talking about actual, tangible silver bars, the metal needed for solar panels, electric vehicles, and electronics. This isn't a promise, it's a finite resource dug out of the ground. And here's the crucial part. All those unlimited paper promises are supposed to be backed by that very limited, very real pile of metal. And that pile of metal is shrinking fast. What we're witnessing is not a regional issue, it's a synchronized global inventory crisis. The drain is happening in the major silver hubs of both the East and West simultaneously. Our first stop is China. As the world's manufacturing powerhouse, China's appetite for silver is absolutely voracious. Their industries consume more than half of all the silver supplied to the global market each year. And right now, that engine is running on fumes. Look at this number, 715 tons. That is all the silver left in the Shanghai Futures Exchange vaults. It's a 9-year low. Now, think about that. Over the last 9 years, China's economy and its need for silver has exploded, yet its available stockpile has dwindled to a dangerously low level. And we can see the desperation in the market data. It's something called the Shanghai premium. This is when buyers in China are willing to pay more for a bar of silver than buyers in London or New York. This isn't speculation. This is a fire alarm. It means giant industrial companies are so desperate for the physical metal to keep their production lines moving that they'll pay whatever it takes. Now, this physical panic isn't just an Eastern story. The shockwaves are hitting the West, right at the heart of the paper market in New York. And what's happening there looks an awful lot like a classic run on the bank. In just a few days recently, entities demanded physical delivery for over 60% of all the registered silver on the COMEX exchange. Let me say that again. Over 60% of the available, deliverable metal was claimed in a matter of days. This isn't just business as usual. This is a massive vote of no confidence in holding a paper contract. The big money wants the real thing, and they want it now. But the story gets even more interesting, because the real shock isn't just the sheer volume of silver being pulled from the vaults. It's who is suddenly at the front of the line, demanding their metal. For years, J.P. Morgan has been one of the biggest suppliers of physical silver into the market. Think of them as the house, always ready to provide metal to meet demand. But in a stunning reversal, they recently took delivery of 371 contracts for themselves, while only supplying 5. The biggest dealer in the casino just walked over to the cashier and demanded to be paid out in gold bars. When the smartest, most connected player in the game abruptly switches from seller to hoarder, you have to pay attention. It's the ultimate insider signal that the physical shortage is real and it's serious. So this begs the billion-ounce question. What is driving this global scramble for physical silver?
The answer isn't a short-term market fluke. It's a deep structural imbalance that's been building for years.
We are now in our 5th consecutive year of what's called a structural supply deficit. In simple terms, it means that for 5 years straight, the world has consumed more silver than every single mine on Earth has been able to produce. This isn't just a bad year, it's a chronic condition. Every year, we're dipping into our global savings account of silver stockpiles, and that account is about to hit zero.
And the scale of this is just staggering. Since 2021 alone, the total shortfall has been nearly 800 million ounces. To put that into perspective, that is almost an entire year's worth of global mine production that has essentially vanished into thin air, consumed by unstoppable demand.
This visual really says it all. You can see here that global mine supply has been basically flat for the better part of a decade. We're not finding much more of it. Meanwhile, industrial demand, driven by essential megatrends like green energy and technology, just keeps climbing. That gap between what we produce and what we need gets wider and wider every single year.
And here's the harsh truth. There is no easy fix for this. You can't just flip a switch and get more silver. Discovering new, high-grade silver deposits is becoming incredibly difficult. And even when a discovery is made, it takes 5, 10, sometimes 15 years and billions of dollars to bring a new mine into production. Supply is rigid. It simply cannot respond to this surge in demand.
So this leads us to the most dangerous part of the equation, the massive amount of leverage built on top of this shrinking supply. This analogy is perfect. It really is like a game of musical chairs, but the stakes are much higher. You have a huge number of paper claims all chasing a tiny amount of real physical metal.
And this isn't just a figure of speech. Right now, on the COMEX, the number of outstanding paper contracts is 244% of the actual registered physical silver available for delivery. That means for every single ounce of real silver in the vault, there are nearly 2.5 paper claims fighting for it. You don't have to be a math genius to see the problem here.
So what happens when all these forces finally collide? You have a multi-year deficit, unstoppable industrial demand, and a flatlined mine supply, all hitting a market that has run out of its inventory cushion. You are creating the perfect conditions for a massive repricing event.
Let's just walk through the chain reaction. First, the years of deficits drain the stockpiles. Second, relentless industrial demand keeps pulling what's left out of the vaults. Third, as those inventories vanish, the market's safety buffer is gone. And finally, you reach a tipping point where the undeniable reality of the physical squeeze simply overwhelms the paper price that has been ignoring it for far too long.
Now, I'm not here to give you price predictions, but the source analysis points to some serious potential outcomes. With the current price sitting where it is, many analysts no longer see $70 an ounce as a far-off target, but as a potential new floor for the price. Looking out a bit further to 2026, targets of over $100 per ounce are considered plausible. This isn't based on fantasy, but on the simple, brutal math of physical scarcity colliding with ongoing currency debasement.
And I think that's the most important thing for you to take away from this analysis. This isn't about hype. It's not about speculation or short-term squeeze. It's about the simple and perhaps inevitable math of scarcity. The physical market is finally asserting its dominance, driven by fundamentals that can no longer be ignored.
Which leaves us all with one final critical question to consider. In a world of vanishing physical metal, what is a paper promise for that metal really worth? Thank you for joining me here at Bullion Signal. If you found this analysis valuable, please like this video and subscribe to the channel for more content to help you navigate these uncertain times. Just a reminder, this content is for informational and educational purposes only. It is not financial or investment advice. Please do your own research and consult with a professional before making any investment decisions. You are solely responsible for the choices you make.